Hi, this is Kevin Kerr for Money and Markets TV. Over the past decade, commodities have been on a remarkable bull run. Prices for the items that most of us use every day, coffee, sugar, gasoline, cotton, corn, wheat, and many more, have risen steadily. And perhaps the biggest winner has been gold, due to its safe haven status as an investment. But the decade-long rally was interrupted briefly in late 2008 and early 2009, when we saw a significant correction. And I see many similarities between that pullback and the violent sell-off we went through last week. There was good reason for that selling pressure. Investors were looking for liquidity, and many of these markets seemed overextended. But there's a difference between short-term conditions and the long-term outlook. And I believe the uptrend in commodities will soon resume with a vengeance. Remember back in 2008, many so-called experts said it was the end of the bull market, but they were wrong. And I see two reasons why anyone making the same claim now is just as mistaken. Number one is a sinking US dollar. In the next few months, it will become clear that the Federal Reserve's twist program is having little, if any, positive impact. When that happens, the Fed will fire up the printing presses yet again and flood the economy with more dollars. That will devalue the US currency. And since commodities are denominated in dollars, it will boost prices even further. Number two is pent-up global demand. China is the world's largest consumer of major natural resources. And as Chinese manufacturing has slowed down recently, that has put a damper on prices. Ultimately, I believe the industry will come back, but it may take a while. And in the meantime, all sorts of commodities have gotten crushed along with the metals and crude oil markets that rely on Chinese demand. This means that cotton, orange juice, corn, wheat, and soybeans are now trading at substantial discounts. I think now is the time to buy these agricultural commodities because their prices won't stay low forever. One key ETF that could help you take advantage of these bargains is the Takurium Corn Fund. The underlying holdings consist of corn futures contracts traded on the Chicago Board of Trade. You can see that this fund recently fell below its 200-day moving average, and it's off about 16% from its high reached at the end of last month. But I think it's due for a rebound. You may also want to consider the iPath Dow Jones UBS Agriculture ETN. This debt security is linked to an index of futures contracts on 7 different commodities. But corn futures make up the biggest chunk at 16.3%. And then there's one of my favorite plays, the PowerShares DB Agriculture Fund, ticker symbol DBA. It follows some of the most liquid and widely traded agricultural commodities in the world. Like JJA, this fund invests most heavily in corn, but it also holds contracts on soybeans, sugar, and live cattle, among other commodities. Remember, while a correction in these markets may be in motion right now, it won't last forever. These are just 3 examples of how to use the downturn to profit from the growing demand for agriculture and soft commodities as they recover. I'm Kevin Kerr for Money and Markets TV. Thanks for watching.